breaking news moments ago. The consumer price index up 0.5% in the month of July. Year over year, prices were up 5.4%. This is in line with what economists were anticipating. Joining me right now is the former Council of Economic Advisors acting chairman, Tyler Goodspeed. And Tyler, it's great to see you again. Thanks very much for being here this morning. Markets are reacting positively to this CPI number this morning. What's your reaction?
Well, my first reaction is there go wage gains for the month of July. Wage gains, nominal wage gains were up 0.36% last month, and this read says that was completely erased by inflation. And at an annualized rate, this number corresponds to an annual rate of inflation of 6.2%. And I think this is why we see now consumer inflation expectations are rising. So long-run consumer inflation expectations ticked up last month to 3.7%. As consumers react to gas, groceries, rent. And I think we saw a similar dynamic in the 1960s and early 1970s when consumers were much quicker to anticipate rising inflation relative to professional forecasters. And so I think the question on my mind is, who do you believe, the Federal Open Market Committee or your lying eyes?
Well, I think that you make a really good point, because for so long we've been waiting and watching to see if wages would start picking up. And in fact, they have started picking up in a big way. People are making more money and better salaries for even, low end of the scale in terms of earnings. And it's being eaten away by inflation because of the higher price for all sorts of goods. What is the reason for that?
Well, I think the main reason is that the administration, fiscal policy, has been putting the cart before the horse. So there has just been a massive amount of demand-side stimulus at the same time that the supply side has been severely constrained, in part because of transitory pandemic-related factors, but also in part because of fiscal policy. So I think last month there was a big jobs number, which the administration celebrated. They really should have been thanking the 26 governors who suspended the emergency federal enhanced unemployment insurance benefits of $300 a week, which had been due. We had legislated in December for that to expire March 14th. So I think the big jobs gains of last month probably should have arrived about 4 months earlier. And I do worry that fiscal policy moving forward is going to add to this inflationary pressure, because it is both pouring more demand-side stimulus onto the fire at the same time that they're constraining the supply-side potential of the U.S. economy.
Well, obviously, there are no worries on Capitol Hill, as well as in this administration. The Senate passed 2 major spending packages in the past 24 hours. 19 Republicans joined all 50 Democrats in voting to pass the $1.25 trillion infrastructure bill yesterday. And then early this morning, Senate Democrats pushed forward their budget resolution bill. They say this bill will total $3.5 trillion, but we know that the true cost is much higher than that, around $5 trillion, according to Maya McGuinness in the Committee for a Responsible Budget. Senator Joe Manchin is raising concerns about the price tag this morning. But progressives in the House are sticking to the promise, emphasizing again in a new letter that they will not pass the infrastructure deal without the spending bill, Tyler. So in order to get those roads and bridges fixed by your house, you've got to agree to a shakedown that Nancy Pelosi has put in place by agreeing to spend $5 trillion on all sorts of other things.
Well, so I can see some political logic in Senate Minority Leader Mitch McConnell supporting the bipartisan deal. It allows him to say to his Democratic colleagues, look, we don't need to end the filibuster because we can still make bipartisanship work. And he can also draw a contrast to the $5+ trillion spending bonanza of the partisan Democrat bill by saying, look, we did infrastructure, which has broad popular support. We did infrastructure the more responsible way. Look, there are reasons to engage in federal infrastructure spending, but I don't think that we should be expecting a big supply side boost from this. I think a lot of people, including the administration, are talking about this as something that's going to ease the inflationary pressure. Look, the average rate of return on $1 in federal infrastructure investment is about 5%. So even a $1 trillion bill is going to raise the potential output by $50 billion. in a $22 trillion economy, that's a 0.2% boost. And that's not even taking into account any crowding out or displacement effects. So actually, the Penn Wharton budget model estimate that it's only going to increase the U.S. economy by 0.1%. And that doesn't even get us into the $3.5 trillion yeah, exactly. And that doesn't even get us into the $3.5 trillion reconciliation bill.
Yeah, Tyler, the bigger point is why all of this spending? I mean, the economy is coming back. We are looking at a growth story continuing. Sure, we may have seen peak growth for the year because the comparisons are a lockdown in 2020. So obviously the comparisons are going to be very good. We were all locked down a year ago. But we're talking about growth in 2021 and growth continuing going forward. Why the need for all of this spending? Why spend another $5 trillion and take our debt above $30 trillion?
Well, I think my former colleague, and your current colleague, Larry Kudlow, put it well when he said, if it ain't broke, don't fix it. And look, the National Bureau of Economic Research officially dated the end of the recession in April 2020. So the Biden administration walked into a recovery that was already 8 months old. I think the problem is that particularly the progressive wing of the Democratic Party have a lot of policy priorities, and this is a unique opportunity for them to get those over the finish line. But as I was saying before, we shouldn't be expecting a whole heck of a lot of growth coming from this because it's basically, I mean, maybe with universal pre-K in 20, 30 years, we can have a higher human capital stock, more educated workforce. Maybe, you know, with the expanded child tax credit, we can get a long-run demographic channel through which we raise potential output. But by and large, this is just imposing a lot of demand-side stimulus. With a lot of impediments to supply-side potential. I mean, the corporate tax rate alone going to 28% would reduce GDP by 0.8%. And furthermore, all these transfers without work requirements are going to lower labor force participation. Yeah.
You make all really good points. I'm glad you mentioned education. We got to get our kids back in school. I have one friend yesterday told me her son has not learned anything in 2 years. She's just devastated by this, hoping that nothing changes for the fall. We'll see. Tyler, it's good to catch up with you, though. Thank you so much. Tyler Goodspeed joining us there on the economy with the Dow Industrials reacting real well to the CPI number, up 62 points right now. Stay with us. We'll be right back.